Good night, students, and welcome to another session of Strategic Business Reported. Now, I had sent you a couple handouts on groups, which I had asked you to read up for tonight's session because most of what you may have read, especially the first handout, okay, which describes some very essential elements of groups. But quite a lot of the initial calculations are things which you ought to be familiar with from your F7. Although having said that, the handout which I sent you, the calculations and explanations, we will quickly go through it. And really, what makes groups different in SPR as compared to financial reporting are the additional elements which you would not have learned there, such as changes in group structures and all sorts of additional complications, which the examiner will test. I can pretty much assure you of that. But before that, I'd like to try and get through the remainder of this handout, okay, and especially this calculations, and then at some point we leave the handout and just go across the groups. Now, one, as I explained to you before, one problem that students tend to encounter when dealing with IFRS 9 and financial instruments, but especially this part of the derivatives, is that students would not have done derivatives and dealt with derivatives in any detail before. It may have been They may have been exposed to it very briefly in the financial management paper, F9 as it was called, but very, very briefly. And for this reason, and indeed from looking at past questions and whatnot, the examiner, if he's testing calculations related to derivatives, the calculations would not be very difficult at all, because it's for him to do that, he's stepping into the area of AFM, advanced financial management. So as long as you can understand certain things and of course look at the accounting aspect of it, and follow the procedure necessary when dealing with certain calculations, then you should be good, okay, for the exam. Because as I said, the examiner will not bring a very testing question involving derivatives. It's really not what he's about at all. So let's take a look. Now I'll explain as we go on. But you've got here derivatives. IFRS 9 says a derivative is a financial instrument with the following characteristics. Now, those of you all who did the advanced financial management paper, because it's likely that some of you all may have, and those of you all who did that paper, okay, should be familiar with derivatives. And that if you can recall that, that certainly would help you. But let's read on, and as I said, I'll explain as we go on. Firstly, its value changes in response to changes in a specified interest rate, security price, commodity price, and so on and so forth. And secondly, it requires little or no initial net investment relative to other types of contract that have a similar response to changes in market conditions. Thirdly, it is settled at a future date. You see, the way derivatives work, okay, in real life, very, very simple. I'll give you a very brief description, which should relate to these 3 points. Is that when someone invests in a derivative instrument, if, for example, okay, you wish to make some money, now you may invest in say coffee bean futures, and if you were to invest in coffee bean futures, okay, the futures is the derivative instrument. As the price of coffee bean goes up, the price of coffee bean futures will also go up. And if you expect the price of coffee to indeed go up, you will enter into an arrangement to buy coffee bean futures at some future point in time. The arrangement is entered into today. When the price of coffee itself goes up, the price of coffee bean futures also go up. You will then close off the deal by selling your coffee bean futures, thereby making a gain. Now, the there are two sides to this. One is the derivative side, which is what a lot of speculators would use. They have no intention in actually buying the coffee. Okay, the other side is the coffee, of course. But as I said, they've got no intention in buying the coffee. Now, you may be saying, but then there's no risk in that, is there? Okay, well, there is. Now, we don't need to get into all the details of the risk aspect related to the use of derivatives, apart from what we need to know for strategic business reporting. But what you need to know is this: the prices of the derivative and the actual instrument, which we call the underlying, tend to, if a gain is made on one of the instruments, a loss would be made on the other. So if a gain is made on the futures, a loss would be made on the actual, and vice versa. Now, derivatives may also be used to hedge. In other words, your intention is actually to buy coffee because maybe you deal in coffee. You know, you stock coffee and you sell coffee on a wholesale basis or something like that. And you wish to protect yourself against rising coffee prices because you buy coffee to sell and you wouldn't like to buy at very high prices. So if you later on, okay, you were to actually buy coffee and the price itself went up, you would obviously, make a bad business, or may have made a bad business decision. Therein lies the importance of a derivative, because if the price of coffee does in fact go up, just as how you would lose out, okay, in one way, in the actual coffee itself, as I said, that's if you actually deal in the coffee, okay, you will gain on the derivative instrument. Okay, and all that you need to know for this paper is that if a gain is made on the actual, a loss would be made on the futures, the derivative, and vice versa. Two losses and two gains cannot be made. Okay, that's impossible. In order to fully understand that, we need to get into the financial management aspect of derivative operations, which we don't need to know for this paper. But as we go on, where necessary, okay, I'll just show you how it works. But I really wouldn't like to go overboard and stray over into AFM, which would really be a bit more confusing than anything else, especially for those of you all who've never done this thing before at all. But these three things is value changes in response to a change in the specified interest rate, security price, and so forth. See, these things here, okay, are the underlying, and the derivative is the actual instrument, the financial instrument used to hedge. So when we say it's value changes in response to a change in specified interest rate, security might be a foreign exchange rate, it might be a commodity itself, those are the underlying. And the futures, for example, is a derivative. Now, there are different types of derivatives, and what you need to know we will discuss shortly. One good thing about derivative for the investor is that the way in which derivatives work, you don't need to put down a very large investment. If, for example, you intend to buy 50,000 pounds of coffee, you need to put out a lot of money to buy 50,000 pounds of coffee. If, on the other hand, you wish to invest in coffee bean futures, futures being the derivative, you really need to put down a very, very small percentage, okay, of the amount of the underlying instrument. Usually it ranges from 3 to 5%. And it is settled at a future date. The problems of derivatives. Derivatives were originally designed to hedge against fluctuations in agricultural commodity prices on the Chicago Stock Exchange. That is, why they were originally used. Agricultural commodity prices, as I said, may go up. So retailers or wholesalers, okay, wishing to buy commodities, agricultural commodities in future, to protect themselves against increasing prices, they may use derivatives. Or as I said earlier, someone as you or I, we have no intention in buying the agricultural commodity. We simply wish to make some money, in which case we can speculate using derivatives, and we don't need to actually invest in the underlying instrument at all. a speculator would pay a small amount, say $100 now, for the contractual obligation to buy 1,000 units of wheat in 3 months' time for $10,000. If in 3 months' time 1,000 units of wheat costs $11,000, then the speculator would make a profit of $900. 11,000 minus the $100, okay, minus 10,000. You know, the speculator would normally, okay, have paid $11,000. This would be a 900% return on the original investment in 3 months. But if the price had dropped to $9,000, the trader would have made a loss of 1,100, despite the initial investment only being $100, because it works in reverse as well. This shows that losses on derivatives can be far greater than the historic cost. Therefore, it is important that derivatives are recognized and disclosed in the financial statements, as they have very little initial outlay, yet expose the entity to significant gains and losses. And this indeed is the main reason, okay, why disclosure is necessary, because the investment necessary, okay, to invest in derivatives, as I said, you know, just invest in the derivative instrument itself, is very small, and it can be easily hidden. The problem is, a small investment in derivatives, okay, may lead to a large, you know, fluctuation in the price of the derivative, and this can actually, okay, cost the company a lot. Companies, for example, which deal in derivatives purely for speculation, okay, may not actually be using derivatives to protect themselves from changes in the actual item itself. Like, for example, they have no intention in buying coffee, but they simply use coffee bean futures to speculate. Now their business may not be anything connected to coffee. Their business may be manufacturing and selling of vehicle tires, but the Treasury Department decides to speculate, and a lot of money can be made. Problem is, losses can also be incurred, huge losses as well. And this is why, because of the risk, the inherent risk involved in the derivatives, okay, the standard requires that this disclosure recognized and disclosed in the financial statements for the benefit, of course, of the stakeholders. Typical derivatives. Now, there are many types of derivative instruments, but for our purpose here, the types that we would normally encounter have been stated with a brief description. Derivatives include the following types of contracts. Forward contracts. The holder of a forward contract is obliged to buy or sell a defined amount of a specified underlying asset at a specified price at a specified future date. For example, a forward contract of foreign currency might require $100,000 to be exchanged for $150,000. Sorry, 100,000 pounds to be exchanged for $150,000 in 3 months' time. Both parties to the contract have a financial asset and a financial liability. For example, one party has the right to receive 150,000, the obligation to pay 100,000. Forward currency contracts may be used to minimize the risk on amounts receivable or payable in foreign currencies. As you may recall from your financial management paper F9, where you actually were shown how to use forwards. Forward contracts can be used to hedge against adverse movements in exchange rate risk. Forward rate agreements. Now, forward rate agreements normally apply to interest rates. So if an investor wishes to speculate in interest rate movements, and he does not actually have a loan or didn't actually make a deposit, so he's not dealing in the underlying, he's merely speculating, or he may actually be dealing in the underlying because he actually has a loan or deposit and he wishes to hedge against adverse movements in the interest rates related to the loan or the deposit, then he may use forward rate agreements. Forward rate agreements can be used to fix the interest charge on a floating rate loan. We say floating because If, for example, an entity has a 5-year loan and the interest rate on that loan will remain fixed. Now that entity does not have to hedge the risk of movements in the interest rate because the rate will remain fixed. The problem is if the entity has a floating rate, a 5-year floating rate loan, where the loan interest rate may be rolled over every 6 months, meaning the interest rates may be adjusted every 6 months according to how interest rates in general change. So if interest rates in general go up, the interest rate applied to this floating rate loan may also go up. And as I said, it may be every 6 months. It's not every day, every 6 months, or it may be annually. Now, in that case, the borrower wants to protect himself against increases in interest rates. And one way to do that is to use a forward rate agreement. If he's an investor, meaning he has a deposit which is subject to a floating rate loan, okay, so he's fearful that interest rates may actually fall, as it's rolled over every 6 months. Again, one way to protect himself is to use a forward rate agreement, because forward rate agreements can be applied both to loans and deposits. Now, as I keep saying though, what you need to know about it is what we are seeing here. There is a lot more to it than meets the eye, literally speaking. For example, an entity has a $1 million floating rate loan, and the current rate of interest is 7%. The rates are reset to the market every 6 months. This is what I was telling you, roll over every 6 months. And the entity cannot afford to pay more than 9% interest. The entity enters into a 6-month forward rate agreement, say with a bank, at 9% on 1 million. If market rate go up to 10, the bank will pay them 5,000. This is something called the compensation effect, 1% of 1 million for 6 months, which in effect reduces their finance cost to 9%. If rates only go to 8%, then the entity pays the bank 5,000. The forward rate agreement effectively fixes the rate at 9%. A forward rate agreement is an example of what we call a perfect hedge, in that the borrower or the depositor knows exactly what the outcome is going to be, and therefore the forward rate agreement being applied to an actual loan or deposit, okay, has effectively removed all of the risk inherent in a floating rate transaction. Now, as I said though just now, on the other hand, a company may not actually be using a forward rate agreement to hedge a loan or deposit. Just as how speculators may use derivatives in general, as I explained to you before with the coffee example, to make money. They have no interest in dealing with the underlying instrument. They have not bought, or they do not intend to buy or sell the underlying. They are merely dealing in derivatives to profit from price movements. In a similar way, okay, an entity may actually enter into a forward rate agreement without the intention of borrowing or depositing. There is no loan or there is no deposit, simply to make money from movements in rates. In this transaction here, this simple transaction shown, the $5,000 received, okay, means that things worked out well for the speculator. On the other hand, the $5,000 paid means things did not work out too good at all. Okay, so all that you need to know is, again, it is a form of a derivative, and it can be used to hedge a loan or deposit. It can also be used purely for speculation. The type of questions which you may be faced with, okay, may involve a forward rate agreement, but usually they tend to relate more to futures and foreign currency. But again, keeping it very simple. Now, futures. I used the example before for coffee bean futures. Futures contracts oblige the holder to buy or sell a standard quantity of a specific underlying item at a specified future date. Now, I'll tell you something about that. If futures are actually being used to hedge an underlying, then of course the company would actually take possession of the underlying instrument. For example, if it's a coffee seller, the um, company, okay, would actually take possession of the coffee in 6 months' time, or whenever. They've got to, because I mean that's what they do, and they may use coffee bean futures to protect themselves against adverse movement in prices. So as I said earlier, if the price of the coffee goes up, the way in which the futures instrument operates, a loss, so to speak, would be made on the actual purchase of the coffee because the price went up, but a gain would be made on the coffee bean futures contract. So actually, it's being used as a hedge. On the other hand, the speculator may have no intention of buying the coffee itself, but simply wants to make some money, realizing, of course, that losses can be made. In the majority of instances, okay, for your exam, you will be dealing with situations where the entity is actually hedging an underlying, rather than merely involved in um, derivatives to make money. It's actually being used as a hedge. You can be asked to deal with a calculation where only the futures contracts or only the forward or whatever are being used purely for speculation. But that's very straightforward. I mean, the examiner, and there isn't a whole lot of accounting as such with that as there is if you were to deal with the underlying as well. Futures contracts oblige the holder to buy or sell a standard quantity of a specific underlying item at a specified future date. Now, as we go on, we'll meet several little examples. Futures contracts are very similar to forwards. The difference is that futures contracts have standard terms and are traded on a financial exchange, a futures exchange, whereas a forward contracts are tailor-made and are not traded on financial exchanges. Forward contracts are normally traded, with banks. Also, forward contracts will always be settled, and futures will rarely be held to maturity. That's right, because most, as you may remember from your F9, most companies using a forward contract actually intend to deal in the currency or whatever item it is. So it will be settled. But with a futures contract, okay, the futures contract will be closed out normally before it actually matures. And that can happen. I mean, it's allowed. There is no need to wait for the actual maturity date of the futures contract for it to be closed out. Swaps, two parties agree to exchange periodic payments at specified intervals over a specified time period. For example, in an interest rate swap, parties may agree to exchange fixed and floating interest payments calculated by reference to a notional principal amount. This enables companies to keep a balance between their fixed and floating rate payments without having to change the underlying loans. Now again, the actual detailed operation of a swap is outside the scope of your syllabus. Whatever you need to know on it is what we will discuss. Options. These give the holder the right but not the obligation to buy or sell a specific underlying asset on or before a specified future date. A contract to buy or sell a non-financial item such as inventory or property or plant and equipment is only a derivative if it can be settled net in cash. Now I explain what this is to you shortly. Or using another financial asset, and the contract was not entered into for the purpose of receipt or delivery of the item to meet the entity's operating requirements. So just to read that back, this does not apply specifically to options, by the way. Okay, the note on options stops here. Now we are just reading on. A contract to buy or sell a non-financial item, such as inventory or property, is only a derivative if it can be settled net in cash and the contract was not entered into for the purpose of receipt or delivery of the item to meet the entity's operating requirements. You see, what we are saying there is this. In this case, okay, the contract was not simply to buy a piece of equipment, full stop. The entity okay, is actually entering into a transaction, which is a true derivative transaction, okay, in order to make money, but the property, the plant and equipment and so forth is being used as the underlying. That's why you were told here, okay, it can be settled net in cash. I said I'll explain that what that is. And the contract was not entered into for the purpose of receipt or delivery of the item to meet the entity's operating requirements. So it's not as though the entity in 6 months' time actually planned to buy a piece of equipment, which is actually the contract being entered into for the purpose of receipt or delivery. It's merely that the entity intends to use a derivative, okay, and the actual property, plant, equipment, or whatever is being used, okay, as the other side of it, the underlying. Right, now here we use the term net in cash. I have a little note here. Derivatives are net settlement. Now there is a further note in Appendix 3 which we take a quick look at. IFRS 9 says that a contract to buy or sell a non-financial item, and as you saw above, okay, a non-financial item would normally be inventory, property, plant, equipment, as opposed to investments and so forth. Um, so a contract to buy or sell a non-financial item is considered to be settled net in cash, where the terms of the contract permit either party to settle the contract net. The entity has a practice of settling similar contracts net. The entity for similar contracts has a practice of taking delivery of the item and then quickly selling it in order to benefit from fair value changes. In other words, he does not intend to actually, as I said, it was not his intention to simply buy a piece of equipment to be used, okay, in the business. It really is a speculative type transaction. And the non-financial item is readily convertible into cash. If the contract is not a derivative contract, then it is a simple executory contract, a contract where neither party has yet performed its obligations. Such contracts are not normally accounted for until the sale or purchase date. That's right. I mean, if the entity actually intended to buy the equipment to be used, that's a different thing entirely. Now, I have a note here. Cash settlement is a method of settling forward contracts or futures contracts by cash rather than by physical delivery of the underlying asset. You see, remember the underlying asset here, okay, may not be changing hands at all. It's just being used as a focus, the other side of the transaction. So any gains or losses, okay, would normally be settled through payment rather than through physical delivery of the actual item itself. The parties settle by paying or receiving the loss or gain related to the contract in cash when the contract expires. Remember, I said earlier that the entity may make a loss on the futures contract. In that case, the entity, being the company, has to pay to the futures exchange, whereas the entity may make a gain on the futures contract, in which case the entity will receive from the futures exchange just the gain or loss, the cash term. Okay. I mean, as I said, it's a little bit, it may be a little bit difficult or confusing because to really fully understand and appreciate, okay, everything, we need to go further into the realms of AFM, which clearly, of course, we can't afford to do. So you just need to go with the flow. The type of questions which you can be asked, I will show you. But just as well as I said, it is not the intention of the examiner to examine this in any great detail, which would really be outside the scope of your syllabus. There is, by the way, a further description as to what is meant net settlement in Appendix 3. As I said, we'll see, we can take a glance at it just now. Measurement of derivatives. Now, of course, your main focus here, remember you are doing SPR, not AFM, and your main focus is knowing how to account for derivatives, derivative accounting then. In advanced financial management, you're not taught how to account for derivatives. You merely taught how to calculate price movements and how to use derivatives as a hedge and the effect of hedging against risk. Here, your main focus is the accounting for the derivative, the debits and the credits then. So on initial recognition, derivative should be measured at fair value. And that's important. Remember, we always have initial recognition, subsequent recognition. On initial recognition, derivative should be measured at fair value. Transaction costs are expense to the statement of profit or loss. At the reporting date, derivatives are remeasured to fair value. Movements in fair value are recognized in profit or loss. Example accounting for derivatives. Entity A has a reporting date of 30th September. It enters into an option on 1st June 25, X5. Remember, the reporting date is 30th November. To purchase 10,000 shares in another entity on 1st November, X5, $10 a share. The purchase price of each option is $1. This is recorded as follows. Now, as I told you, as we go on, I'll give you a brief explanation. Okay, so hopefully this will enable you to understand the transaction better. If an entity wants to buy shares in future, okay, I mean, of course, it must be in another company. Now, it's not as though the entity intends to go to the other company and buy the shares. Of course, the shares can be purchased on the stock exchange. And in future, in this case, okay, on 1st November, entity A wants to buy 10,000 shares. But entity A, okay, is fearful that the price of the shares may go up. So one way of protecting themselves, okay, is to use options, okay, call options. Now, the entity, okay, would start off by buying options, and this is what you see in here, okay. The purchase price of each option is $1. It enters into an option arrangement, and the entity is purchasing 10,000 options. You know, one option per share, then, so to speak. That's keeping it very simple. One option may involve more than one shares, but you know, say one option per share. And what the entity would therefore pay at the start, okay, is $10,000. Now, unlike a straightforward investment, of course, by the way, okay, a share, purchasing shares is an example of a financial asset. Remember, we saw that earlier. It's not a non-financial item, it is a financial item. So the entity, you know, in buying the option, okay, is literally buying the right to purchase 10,000 shares for $10 a share, regardless of what the price of the share goes to. That is what they would pay, and they would pay that price, okay, to the seller of the option. You know, if initially the option has been bought, it will be bought from a market maker, someone who, you know, deals in options then. And that is the seller of the option. The seller of the option would receive the $10,000. If the entity A later on decides to exercise the option and buy the shares, remember, it does not have an obligation, it has a choice, an option. Okay. If it decides to exercise this option and buy the shares, the seller of the option, i.e., the recipient of the $10,000, must deliver up the shares, as we will see. So the initial transaction, again, which you would not have dealt with, okay, if you had been doing advanced financial management, where you are not too concerned with the accounting, but the initial transaction would have been to debit the option $10,000, credit cash $10,000, cash is paid. Now, that has to be done, okay, at the start. The next thing that has to be done, although the potential exercise date is 1st November, if the entity's reporting date is 30th September, at 30th September, an accounting entry has to be done reflecting any changes in the value of the option. Remember here you're told should be measured at fair value, and then at the reporting date, we measure to fair value with movements in fair value recognized in P&L. So by 30th September, the fair value, okay, of each option has increased to $1.30. That is what is being assumed here. In that case, now of course, it does not mean that entity is literally paying more at that point, but the option itself has to be revalued. In that case, the increase is recorded as follows. Debit option, literally, it's as though it's an asset and you're lifting the value up, okay? $3,000, credit profit or loss, $3,000. Now, this was at the reporting date. Remember, the transaction date is the 1st November. On 1st November, the fair value per option increases to $1.50. So the option value goes up again. Now, what you normally find is that there is a positive correlation between the fair value of the option and the price of the share. Usually, as one goes up, the other one will go up as well. What normally would go up first is the price of the share. You see, the option is the derivative and the share is the underlying. And all derivatives operate in the following way. If the price of the underlying goes up, the price of the derivative will go up as well. If the underlying goes down, the price of the derivative will go down. And that is why, okay, if a loss is made on one side of it, a gain will be made on the other. It's because of the fact that the price is actually moving the same way. Now, you may be saying to yourself, but then if the price is moving the same way for both of them, how could a loss be made on one and a gain be made on the other? Well, it has to do with the way in which the transaction takes place. The way in which the transaction takes place would ensure that if a gain is made on one side of it, a loss will be made on the other, and vice versa. On 1st November, the fair value per option increases to $1.50. The share price on the same date is $11.50. Price of the share, has risen. A exercises the option on 1st November, and the shares are classified at fair value through profit or loss. Remember, we came across this term before, financial assets classified at fair value through P&L, okay, or financial assets valued at fair value through OCI. If, of course, A intends to deal in the shares regularly, it would be classified at fair value through P&L. Financial assets are recognized at their fair value, so the shares are initially measured at $115,000. Now, by the way, notice here in this example, the actual share price went to $11.50, whereas the price applied to the 10,000 shares in the agreement was $10. As long as the actual price of the share increases above the contracted price, it makes sense for A to exercise. The reason being, because A will only pay $10 a share for something which is worth $11.50. Now, of course, A is not buying the shares from the stock market. As I told you, it will be bought from a market maker, someone who deals in options. Because if A had to go to the stock market and buy the share, they cannot buy the share at $10. They would have to pay the going price. This, of course, is why A entered into an option arrangement. If the price of the share, however, had fallen below $10, then A will not exercise the option, because it makes no sense paying $10 to the market maker for something which can be bought in the market for $9. That's why here you've been told A The share price is 11.50. A exercises the option on 1st November, and the shares are classified at fair value to P&L. Financial assets are recognized at their fair value, so the shares are initially measured at $115,000. The double entry: debit investment in shares, $115,000 fair value. Credit cash, $100,000, and this cash will be paid to the seller of the option, the market maker, okay, who has to deliver up the shares now and must only charge a $10. Now this means this market maker made a loss, because this market maker would have had to pick up the shares at 11.50 and sell them at 10. And of course, there's a risk involved. And the whole idea is the premium paid would go partly or fully towards covering that risk. But as I always tell students, remember, people who deal in options, okay, meaning traders than market makers, as I've been calling them, it's not a one-sided. They would be dealing, okay, in different types of transactions, different types, calls and puts, where somebody, buys a call, somebody buys a put, which is an option to sell, So it's not as though it's a one-way street, but we don't need to get too much into that side of it, okay? So credit cash, this will be paid over to the seller of the option, who now must give the shares at $10. The A. Credit option, okay, $13,000. This is to remove it from the books. Remember, it was 10 and it was 3. And credit P&L, gain on option 2. Now, notice the gain was 2 here, okay? And the gain was 3 here, both recorded in P&L. This could have been calculated in a different way. For those of you all who may have been exposed to option calculation from a financial management point of view, you would have realized that the profit and loss is not calculated, okay, periodically like this. And this is of course one of the way in which it differs, looking at it from a financial management perspective and a financial reporting perspective. From a financial management perspective, it may have been calculated like this. Okay, movements in fair value are recorded as they occur. That's how we showed it here, and of course down here. Not all at the end. Now, from a financial management perspective, you may just do one calculation at the end. The total gain would be the same as shown here, but for financial reporting, it has to be revalued to fair value at each reporting date. The overall gain, if recorded at the end, would still be a total of 5 as shown below. Start, the cost of the option was 10,000. This is a cash item paid out. End, the cost of the shares is 100,000. This is also a cash paid out. So that's a total of $110,000. End value of the shares, $115,000. Now, what that literally means is that the investor has something worth $115,000, okay, for paying out a total of $110,000, and the investor makes an overall gain of 5. So if it was done in one calculation, it would have been done this way, but for financial reporting purposes, it has to be done in this way, because it has to be done, periodically at each reporting date being valued, fair value. Now, of course, what we are valuing here is the derivative. What we are valuing at the reporting date is the derivative. I have here made up of increase in fair values of P&L on 30th September 3 plus gain at the end 2000, which is how we arrive at the 5. Let's take a look at this question. Where was it? Okay, Hoggard. Yes. Hogarth buys 100 options on 1st January X6 for $5 per option. Now remember, this is just the option. This is the derivative. This is not the share. The one thing here I must tell you again. This is a option on a share, meaning this is a call option on a share, as in the previous example we looked at on the handout. But there are different types of options related to different types of instruments. For example, if an importer and exporter is dealing in foreign currency and wishes to protect himself against adverse movements in the exchange rate, he may use currency options. If an investor has a loan or deposit and wishes to protect himself against adverse movements in interest rate, he may use an interest rate option. This is a share option because it relates to a share. But there are many different types of options. So Hogarth apparently, wants to buy some shares and wishes to at least, have some sort of guarantee as to what price they'll be paying, maybe a maximum. Hogarth buys 100 options on 1st Jan for $5 per option. Each option gives Hogarth the right to buy a share in Rowland at 31st December for $10 a share. How should this be accounted for given the following outcomes? Now remember again what we are concerned with is the accounting. One way the examiner may test this type of thing is this, rather than it being a question on itself, which is really not possible for him to ask you a question which deals with derivative calculations alone. Okay, but one way in which he may ask this is, you're doing one of the big questions, say 30-35 marks as the case would be, and as part of the question, okay, he chose in a bit of derivatives like this, and one of the scenarios which may be present is that the finance director has accounted for it incorrectly, and you've been asked to show the journal entries necessary to correct that. Or of course the question may ask you, to discuss something in relation to what has been done. You see, rather than, as I said, being asked a dedicated derivatives question, which is something that could be asked in AFM, but not in your paper. So each option, coming back to this, gives Hogarth the right to buy a share on 31st December for $10. How should this be accounted for? Scenario A, the options are sold on 1st July X6 for $15. Now notice, and again, this question allows me to explain again in a little more detail how the options actually work. Since the options were bought on 1st January, now of course the options give Hogarth the rights to buy a share in Rowland at 31st December. But the options are financial instruments as well. The options are also traded, okay, on an options exchange. So just as how Hogarth bought options, Hogarth may turn around and get rid of the options. Maybe Hogarth has no actual intention of buying shares. Hogarth simply wants to make some money. Okay. Now in that case, he may sell the option before. If he did intend to buy shares and he still intends to buy the shares on 31st December, but in the meantime he got rid of the options, then of course he will not be protected anymore. It's only holding on to the options will give him that protection come 31st December. So the first scenario being presented here, for you to account, the options are sold for $15 each on 1st July. Now, if we were to look at this, in all scenarios, the cost of the derivative will be the same, 100 by $5. And an asset is recognized in the statement of financial position. Debit an asset, the option, same thing as what we saw here. Let me just show you. Okay. Yeah, when we debited the option. Debit asset 500, credit cash. Option outcome A. If the option is sold for $1,500 before the exercise date, well, obviously it has to be derecognized from the balance sheet. So we debit cash 1,500, credit the asset 500, that's removing it from the books, and crediting profit or loss 1,000. Option B. On 31st December, Rowland share price is $8 and Hogarth lets the option lapse. Right. Remember what I told you before in the previous example. If the actual price of the share falls below, okay, the $10, the exercise price as it's called, it makes no sense exercising the option. That would mean paying to the market maker $10 for something which is actually worth $8. So if Hogarth really wanted to own shares, in that case, Hogarth would allow the option to lapse and he can pick up the shares at $8 in the market. Now, in case you're saying, but he paid he paid a price up front, $500. Yes, and that is the cost of the option. So that's something that he must recognize and he must bear. Okay, you can think of it as a transaction cost. Indeed, if he wants to show the total outcome, he will consider the $5 as well. See, like this. B, it's now $8. Hogarth will in fact allow the option to lapse, meaning he will not exercise. If the option lapses on exercise, then it is derecognized and there is a loss to be taken to P&L. Now it has to be derecognized, remember it has to be removed from the books, thereby crediting the asset, but debiting P&L, okay, because there is a loss, okay. See, the reason why there's a loss is he paid $500, okay, and it comes as though it came to nothing. He didn't make use of it. You see, it is a cost. Outcome C, the option is exercised when Rowland's price is 25. Now, clearly, if the price goes above, as I said, the exercise price, it makes sense to exercise because you can actually pick up something at $10, which is actually selling for $25 in the market. So he will exercise this option, go to the market maker and say, look here, this is my $10, give me a share. And if he wants at that time, he can immediately sell back the shares in the market for $25, which we are not showing here. Okay, but of course, that is one possibility. If the option is exercised, then the option is derecognized. The entity records the cash paid upon exercise, and the investment in shares, okay, is recognized at fair value. An immediate profit is recognized. Debit the asset, $100 at 25. Remember, that's the fair value now of the shares, 2,500. And that's a good starting point, really, if you have to record the double entries. Credit cash, $1,000. Okay, this is of course what he will pay to the market maker. To get the shares. Credit asset option, that's the $500 above. To remove it from the books, remember it must be removed from the books. It has to be derecognized. That's why even here it was derecognized. And credit P&L 1,000. Now I showed you here, okay, an alternative way of arriving at the $1,000. This is perhaps how you may have done it if you were just being, let's assume that you were doing a simple financial management calculation and you wanted to show the gain, okay, where you don't need to do the double entries then. It could have been done like this. Initial cost of the option, $500, which is a negative. Cost of the shares 1,000, which is of course what he paid at the end. Value of the shares 25, okay, and therefore the overall gain is 1,000. But you need to know how to show the double entries. Now, there's another reason why you need to do this, because, as I said, if you were to use the scenario I made up a few minutes ago, where it's part of a big question, just a small part, and the finance director or someone may have recorded it incorrectly, and you've been asked to show the journal entries to correct it. The only way you can show the journal entries and know what to do is if you knew what to do at the start. In other words, the correct way of doing it then. Okay, so, again, this is what we are interested in. Now we come to something called embedded derivatives. Now, this is taking it up a notch, but as I said, I'll try to keep it simple. Something embedded means something which is a part of something else. So an embedded derivative means the derivative is actually a part of something else. A good example is a convertible bond, which is usually the example the examiner tends to use. Okay, let's read and I'll explain. An embedded derivative is a component of a hybrid contract. See, hybrid means it's a mix then. That also includes a non-derivative host, with the effect that some of the cash flows of the combined instrument vary in a way similar to a standalone derivative. Now let's read that again. It's a component of a hybrid. Remember, the embedded derivative is the derivative we are talking about. It's a component or a part then of a hybrid contract that also includes a non-derivative host, with the effect that some of the cash flows of the combined instrument vary in a way similar to if the derivative was standing on its own. Now, a good example, as I said, is a convertible bond. You may recall, okay, from what we did on this handout earlier, as well as from your knowledge F9, a convertible bond gives the bondholder the right, or he has the option then, in other words, to take redemption proceeds, redeem the bond then, or to convert it into shares. Now, in that case, the non-derivative host is the bond itself. The derivative component is that right to convert into equity or to take the redemption proceeds, the right itself, similar to an option as what we saw earlier. So in this last part of it, with the effect that some of the cash flows of the combined instrument, some of it vary in a way similar to the standalone derivative if we were using options alone then. Okay, really, you see, the potential cash flows would be comprised of the cash flows related to the non-derivative host, which is the bond itself, and the cash flows related to the derivative, which is if he decides to exercise or not exercise, and so forth. But that is, the classic example of an embedded. Now, there are others, of course. I mean, I have a link here which you may follow, okay, and get some further insight into it if you wish. But be careful, because don't be overwhelmed by it. Don't go to town on it, so to speak. Okay, just learn what you need to learn, which is what we are looking at here. With regards to the accounting treatment, which is again our concern, of an embedded derivative. Now, in your financial management, okay, for those of you all acquainted with this sort of thing, you didn't need to worry about the accountant. But here, this is our focus. With regards to the accountant, if the host contract, that's the actual bond then, is within the scope of IFRS 9. You know, like if let's say the investor invested in a bond, okay? So it's a financial asset then. So if the host contract is within the scope of IFRS 9, then the entire contract must be classified and measured in accordance with that standard. If the host contract is not within the scope of IFRS 9, that is, it is not a financial asset or liability, then the embedded derivative can be separated out and measured at fair value through P&L. If, now, let's again consider, if the host contract, meaning it's a financial asset such as an investment in the bond of a company, as we saw, investment and debt, as we saw earlier in this handout, now that's a financial asset. So if the host contract is within the scope of IFRS 9, then the entire contract, made up of course of the host and the derivative, must be classified and measured in accordance with that standard. But if the host contract is not within the scope of IFRS 9, then the embedded derivative can now be separated out and measured at fair value through P&L. Now let's read on before I explain further. So can be separated out and measured at fair value through P&L. If 1, the economic risk and characteristics of the embedded derivative are not closely related to those of the host contract. You see, what we are actually saying here is that if they are, yes, 1 because it's embedded, but IFRS 9 says that the host is not a financial asset or liability, then it comes as though they are not as closely embedded as if it was within the scope of IFRS 9. Now, if it is not as closely embedded, and I'm using this to explain, to help you to understand these things, if according to IFRS 9, it is not closely embedded because the host is not a financial asset or liability, then IFRS 9 allows for the separation of the two, measured at fair value through P&L, if 1, the economic risks and characteristics are not closely related to those of the host. 2, a separate instrument with the same terms as the embedded derivative would meet the definition of a derivative, meaning that if it's a separate option, then remember the convertible right is an option. So if you were just dealing with an option, then it would look similar. And 3, the entire instrument is not measured at fair value. It changes in fair value recognized in P&L. Now, note this, however, because of the complexity though involved in splitting out and measuring an embedded derivative, IFRS 9 permits a hybrid contract where the host element is outside the scope of IFRS 9 to be measured at fair value through profit or loss in its entirety. Therefore, for the vast majority of embedded derivatives, the whole contract will simply be measured at fair value through P&L. You see, in other words, then we would treat it similar to if the host instrument was truly a financial asset or liability under IFRS 9. What you see here, because of the complexity involved, and there is a lot indeed of complexity, and not only complexity, it's prone to random movements. Because of the complexity involved in splitting out and measuring the derivative, IFRS 9 says, you know what, just go ahead, and treating it as at fair value in its entirety, fully then. Now, actually, just a point of reference, that's exactly how US GAAP tend to treat it. Although IFRS 9, of course, international standard as opposed to US GAAPs. Although the international standard IFRS allows a degree of flexibility here, because you said it allows for it to be treated in this way. It permits then, okay? It's not mandatory, but it permits, more than likely it will be treated this way, okay? US GAAPs does not give you a choice. They quite simply say it has to be, okay, measured in this way in its entirety. Therefore, in the vast majority, the whole contract will simply be measured at fair value. Now, just to show you an example, an entity has an investment in a convertible bond, which can be converted into a fixed number of equity shares at a specified future date. The bond is a non-derivative host contract. Well, clearly the bond is a non-derivative, but it is a host contract. And the option to convert is therefore the derivative, as I said earlier. Okay. The host contract, the bond, is a financial asset. Well, as we saw earlier on this handout. And so is within the scope of IFRS 9. This means that the rules of IFRS 9 must be applied to the entire contract. The bond would fail the contractual cash flow characteristic test, and therefore the entire contract should be measured at fair value through P&L. This is just as we saw it earlier on the handout. Okay. Remember, I explained to you what is meant by this sort of thing, because the bond here has the option part applied to it. Remember, at the end of it all, either the redemption proceeds may be paid or it may be converted into shares. So a simple embedded derivative, okay, would look like this, right? The host contract, it is within the scope of IFRS 9. This means the rules of IFRS 9 must be applied to the entire contract, and in that case, we find. Now, if for some reason the host was not a financial asset, remember you were told here, okay, that because of the complexity involved in splitting out, IFRS 9 permits the hybrid contract where it is outside to be measured at fair value through P&L in its entirety. Now, one of the problems, in fact, I would say the major problem, so far what we've been looking at shouldn't have caused you any problem. I mean, I've been explaining as we go on, as we went on. But before we look at this other piece, hedge accounting, do not mix up or confuse embedded derivatives with a transaction which does not involve an embedded derivative. What I mean, for example, is this. Earlier, we saw where the entity A wanted to buy a certain amount of shares in future. And to protect themselves against adverse movement, they decided to use a call option, which is a derivative instrument. Now that transaction was not an example of an embedded derivative. It's two entirely separate things. Okay. They are not, one is not literally tied in or embedded to the other. Remember, you saw in that example that the options, in one of the examples, that the option can be sold separately. You see? So that's why I said that usually, I mean, the typical embedded derivative, which literally has the two parts embedded into it, part and parcel, okay, would normally be a convertible bond. Now, the biggest challenge for students, okay, in financial instruments really is hedge accounting. Now, again, those of you all who did AFM or any similar course of study, okay, you would have you would be familiar with hedging. In fact, we've been talking about hedging earlier in this handout, haven't we? Where a hedge is set up. Okay, a hedge is to protect the investor, the speculator, against adverse movements, okay, in the price of the underlying. So if, for example, the investor, okay, wanted to buy shares, okay, as we saw in an earlier example, and the investor wants to protect himself against increasing prices of shares when he comes to buy it, okay, he may hedge the effect of the increase using call options. But what we are dealing with here is hedge accounting. Now this takes it a bit further. Now, one thing I'll tell you though, if hedge accounting is applied, it may actually go outside the scope of certain standards, as you will see shortly in an example, which is why hedge accounting is not mandatory. If a company, okay, is exposed to, movements in prices and so forth, as in the examples that we will look at, it may or may not use hedge accounting. Hedge accounting is not mandatory. And one reason for that is because when hedge accounting is applied, it actually may change how we would normally do things had the standard itself been applied, the relevant standard, say like IAS 2 inventory. Let's take a look and I'll explain further. The need for hedge accounting, firstly. An entity has an inventories of gold that costs $8 million and whose value has increased to $10 million. The entity is worried that the fair value of the inventory will fall. And so it enters into a futures contract on 1st October X1 to sell the inventory for $10 million in 6 months' time. By the reporting date, the fair value of the inventory had fallen by $1 million to $9 million. There was a $1 million increase in the fair value of the derivative. Right, now take a look at this example here. The actual price of gold had fallen by $1 million, the stock then. It went to 9 million. But, okay, remember what I told you. If a loss is made on one part of the transaction, in this case the underlying, the price actually fell, a gain would be made on the other side, the futures. Now, we don't need to actually get further into why and how the gain was made in the derivative. That would, as I said, be more, a financial management thing. All that you need to know is that if the price, okay, of the underlying moves in such a way that a loss is created, a gain will be created on the other side, the futures. If the price of the underlying moves in such a way that a gain is made, then a loss would be made on the other side, the futures. Further into the calculation as to how and why and so forth is not what we are about here. So by the reporting date, the fair value of the inventory, as the gold, had fallen by $1 million, and there would be therefore a loss, so to speak, as compared to the original fair value. But there was a $1 million increase in the fair value of the derivative. Now, the $1 million is the same in this case. It need not be the actual amount, by the way. Now, in most cases, when you are dealing with hedge accounting, okay, the movement in prices, the movement in the gains and losses will be the same. So there'll be an exact compensation, 1 million to 1 million. But again, and I mean, at the risk of repeating myself, For those of you all who did any advanced financial management studies, you realize that the movement in both of them may not be the same, which gives rise to something called an imperfect hedge. But, just following on here, it offset, fell by one, there was a gain on the other. In accordance with IFRS 9, the 1 million gain on the derivative will be recognized through profit or loss, debit derivative, credit P&L. In accordance with IAS 2, the 1 million decline in the inventory's fair value though will not be recognized because inventories are measured at the lower of cost on NRV. 8 million, NRV 9 million. Okay. Now, that is how it would be done if hedge accounting did not apply. If hedge accounting, remember I told you hedge accounting is not mandatory. So let's assume hedge accounting was not being applied. The transactions, okay, the transaction to be carried out would simply be the movement on the derivative. Because in this case, according to IAS 2, the 1 million decline, it will not be recognized because according to IAS 2, inventories are measured at the lower of cost and net realizable value. What you will see, however, is that if hedge accounting was used, you'll see the same example in a little while, it will be different. In other words, what you will see is if hedge accounting was used, the value applied to IS2 would not, sorry, let me repeat that. The value applied to the inventory would not be the same value as if IS2 had been used. And this is one reason why I mentioned a few minutes ago that hedge accounting is not mandatory, because often what would happen is that it would, create a transaction which is not in accordance with the standard, with that of another standard, in this case IS2. But let's read on and you'll see. The derivative has created volatility in the profit or loss. The reason why we say has created volatility is there's a sudden increase of 1 million in the profit or loss. Now, of course, you might say, well, there's nothing wrong with that. Remember, it could have gone the other way, by the way. However, if the entity had chosen to apply hedge accounting, this volatility would have been eliminated, and I'll show you how in a little while. So if hedge accounting had been used, the volatility would have been eliminated, because what you would have seen is there would have been another side to it as well. So rather than simply showing a big increase in profit, okay, you would have seen if it moved equally and we were using hedge accounting, it would have been fully or partially offset, thereby removing the huge volatility. So, however, if the entity had chosen to apply hedge accounting, this volatility would have been eliminated. This section of the handout will outline the criteria for an accounting treatment of hedge accounting in more detail. Now, take a look at the note on the right-hand side, the comment. Hedge accounting, is a method of accounting where entries to adjust the fair values of a security and its opposing hedge are treated as one. Hedge accounting attempts to reduce the volatility created by the repeated adjustment of financial instruments' value, known as fair value accounting or mark to market, which is the term used in financial management. Then, lower down, I have hedge accounting is not mandatory, it is optional. So you can select not to follow it and recognize all gains or losses from a hedging instrument to P&L, as what we did here. Now again, as I said, we'll take the same example and show you how it would have looked if hedge accounting had applied. Definitions. Hedge accounting is a method of managing risk by designating one or more hedging instruments so that their change in fair value is offset in whole or in part by the change in fair value or cash flows of a hedged item. In other words, the underlying them. See, if we apply hedge accounting, there'll be two sides to it then. And there's where we wouldn't just have a sudden increase or decrease in profit, because one part will offset the other. A hedged item is an asset or liability that exposes the entity to risks of change in fair value of future cash flow and is designated as being hedged. Now, this is the hedged item itself. So, for example, this might be this might be the stock of gold. Okay, don't mix up the hedged item with the hedging instrument. The hedged item is the item being hedged. There are three types of hedged item. Now, these definitions may seem a little bit technical, but when we get into the actual calculations, you realize that it's not difficult to deal with, as I'll show you, and I'll relate back to the definitions. Um, uh, right. So there are three types of hedged items: a recognized asset or liability, an unrecognized firm commitment, a binding agreement for the exchange of a specified quantity of resources at a specified price or a specified future date. Okay, something as a normal futures then. And thirdly, a highly probable forecast transaction, an uncommitted but anticipated future transaction. Now, these are the actual terms used by the standard. Okay, and as I said, I'll show you how they apply as we look at questions. Note I have these arrows. Okay, and let's just read this, and I'll show you what the arrows relate to. Types of hedge accounting. IFRS 9 identifies three types of hedge. Two of these are within the SBR syllabus. Firstly, what we call a fair value hedge. Now, you need to know how to deal with both these types, and it's really not difficult at all. A fair value hedge, a hedge of the exposure to changes in fair value of a recognized asset or liability, or an unrecognized firm commitment that is attributable to a particular risk and could affect profit or loss or other comprehensive income for equity instruments valued at fair value through other comprehensive income. Now, again, more than a mouthful, but this is the definition according to IFRS 9. What I need to show you is how to simply deal with it, which we'll look at shortly. And cash flow hedge. Now, by the way, usually what the examiner will do when dealing with a question on hedge accounting, he'll tell you the entity or something like this, the transaction satisfies the condition to be recognized as a fair value hedge or something of the sort then, okay? Leading you to, well, is it fair value hedge or is it a cash flow hedge? Cash flow hedge, a hedge of the exposure to the variability in cash flows that is attributable to a particular risk associated with a recognized asset or liability or a highly probable forecast transaction that could affect. Again, this is the definition of IFRS 9. I mean, and in case you're saying to yourself, could they not have made it a bit more understandable and a bit more? Well, you see, it's like this, right? I think you will agree that most of the standards that we've seen so far, the IS, the ISB, they do a pretty good job of keeping it simple. In other words, the explanations. The problem is this. Now, financial instruments were not always the subject of a standard. There was previously IS 39. Okay, well, there's no IS 39 anymore. Anything which was involved with IS 39 is now here. And IS 39 was a very confusing standard. Financial instruments here, IFRS 9 in particular, is also not the easiest standard to follow. One reason for that is because what we are doing here is we are effectively dealing with two areas of study. We are dealing with accounting and we are dealing with financial management. And this is why, okay, you will find the standard itself and some of the definitions, okay, look a little bit complex or confusing. Because since we are dealing with two areas of study, financial management and accounting, rather than pure accounting, okay, you would see some of the definitions, a bit confusing to deal with. I mean, I will tell you it is, because in surveys taken, from students, asked, what do you consider to to be one of the most challenging standard. They would say IFRS 9. So, but my job, as I said, to show you how to deal with the accounting aspects. If it's a fair value hedge, if it's a cash flow hedge. I have these little arrows here. Anytime you are dealing with a question and there is a so-called asset or liability, note how this arrow goes, comes down here, you will be using a cash flow hedge. Anytime it's the second one, let's say the question just tells you it's an unrecognized loan commitment, but usually the question would be a bit more explicit. Okay, we are dealing with a fair value hedge, and this one is also a cash flow hedge. Now again, as we do the questions, I'll explain further. Criteria for hedge accounting. Now, for hedge accounting to apply, there must be certain criteria in place. Usually when you're doing questions, if the examiner wants you to apply hedge accounting, what you may see is the question may state all of the conditions for hedge accounting have been satisfied. So under IFRS 9, hedge accounting can only be applied if the hedging relationship meets the following criteria. Firstly, the hedging relationship consists only of eligible hedging instruments and hedge items. Items, for example, which fall under financial asset or financial liability. At the inception of the hedge, there must be formal documentation identifying the hedged item and the hedging instrument. So we can't just say, well, okay, you know what, let's just move on. There must be some sort of a formal recognition of the two. The hedging relationship meets all effectiveness requirements discussed in more detail below. Now, remember, you saw here that there are two types, okay, of hedges within the SBR syllabus. One is a fair value hedge, one is a cash flow hedge. Accounting treatment of a fair value hedge. So if you're doing a question and you're faced with a transaction and the question indicates or leads you to believe it's a fair value hedge, this is what we are dealing with. At the reporting date, the hedging instrument will be remeasured to fair value. The carrying amount of the hedged item, so no, the hedging instrument like the futures then will be remeasured to fair value. The carrying amount of the hedged item, whatever is being hedged, will be adjusted for the change in fair value since the inception of the hedge. The gain or loss on the hedging instrument and the loss or gain on the hedge item. Notice how it's phrased. The reason why it's been phrased like this is because, as I've been saying, if there's a loss on one, there'll be a gain on the other and vice versa. So the gain or loss on the hedging instrument and the loss or gain on the hedge item will be recorded in profit or loss in most cases. So if it's a fair value hedge, in most cases, the gain or loss on both instruments, on both transactions, the hedged item as well as the hedging instrument, will be recorded in profit or loss. But the gain or loss would be recorded in other comprehensive income if the hedge item is an investment in equity that is measured at fair value through OCI. Now remember earlier in the handout, we saw that if an investment in equity, okay, is measured at fair value through P&L, that means that the investor, the company then buying the shares, intends to regularly buy and sell shares. In other words, hope to profit from price movements quickly then. But if on the other hand, the investor intends to hold on to the equity a bit, then it is normally measured at fair value through OCI. What you've been told here is this: the gain or loss on the hedging instrument and the loss or gain on the hedge will be recorded in P&L in most cases. And indeed in most, because even if we are looking at investment in equity, most companies may invest in shares to profit from movements in the price. That's their intention. but it will be recorded in other comprehensive income if the hedge item is an investment in equity that is measured at fair value through OCI. Okay. Of course, a question must indicate which is it is. If a question does not, and you are simply dealing with an investment in shares, and and you need to apply hedge accounting, well, you will record any gain or loss in profit and loss. A simple fair value hedge, right? Now, what we are doing here is using the same example as what we saw earlier. Remember the example we saw earlier when no hedge accounting was used? Which applied to the inventory. Remember, all that we saw was a big credit to profit, and you saw that not applying hedge accounting when dealing with a derivative instrument would lead to sudden increases in profits or losses. But I told you then, applying hedge accounting, which is one of the reasons why hedge accounting, okay, came about then, so to speak, is to smooth out that jerky effect. So simple fair value hedge. An entity has inventories of gold that cost $8 million, just as the first example, but whose value has increased to 10. The entity is worried that the fair value of this inventory will fall, so it enters into a futures contract on 1st October X1 to sell the stock, the inventory of gold, for $10 million in 6 months' time. So notice it enters into the futures contract on 1st October. All right, that's when the agreement was made. It's not as though the gold itself will be sold on the 1st October. That's when the agreement was made. And this was designated as a fair value hedge. See, this is what I was telling you, how the examiner may hint it to you, which is what we are dealing with here. Okay. By the reporting date on 31st December, now remember 6 months from 1st October takes us into March next year. But remember, at the reporting date, you have to account for movements in fair value. By the reporting date on 31st December, the fair value of the inventory had fallen from 10 to 9. And there was a 1 million increase in the value of the derivative. Now, in the previous example, when we saw this, remember how we recorded it? The entity believed that all effectiveness criteria have been met. In other words, then, this. For hedge accounting to be used, these things must apply. And this is how the question would normally phrase it. Under a fair value hedge, the movement in the fair value of the item and instrument since the inception are accounted for. The gains and losses will be recorded in P&L. Now, previously, this is all that we saw. When hedge accounting was not used, this is the only thing that happened. We debited derivative, credited P&L. Now, in this case, the 1 million gain on the future, 1 million loss on the inventory will be accounted for as follows. This, then debit P&L, credit inventory, because remember there was a fall in price. See, the reporting date. 10/9. By applying hedge accounting, the profit impact of remeasuring the derivative has been offset by the movement in fair value of the inventory. Volatility in this case has been eliminated. Note, and this is very important, and this would normally be an effect of applying hedge accounting. Note that the inventory will now be held at 7 million. Remember, the original cost was 8. And look at the double entry. Credit inventory 1, 7. This is neither cost nor NRV. The normal accounting of inventory has been changed by applying hedge accounting rules. This is one reason why I have noted the comment, remember, hedge accounting is not mandatory. I told you that usually, okay, it would conflict with the application of the typical standard, usually IAS 2. But if hedge accounting is used, if the entity decides to use hedge accounting, and the entity can only decide to use hedge accounting if these criteria have been satisfied, then so be it. Okay, now we've got a couple of examples here. In fact, two of them. Firstly, these two examples, fair value hedge 17 and 18. So let's go to our worksheet. On 1st January, Exeter an entity purchased equity instruments for their fair value of $900,000. They were designated upon initial recognition to be classified as fair value through OCI. Now, don't mistake this with fair value hedge as opposed to cash flow hedge. This is simply what we will do regardless. If the investment is an equity and if it's designated as fair value through OCI. Remember though, if it is specifically designated as fair value through OCI, then any gains and losses resulting from the hedge account will go through OCI. Whereas if this line had not been given to you, you could have assumed that any gains and losses would go to P&L. You saw that on the handout just now. On 30th September, the equity instrument was still worth 9, but the entity became worried about the risk of decline in value. It therefore enters into a futures contract to sell the shares for $900,000 in 6 months' time. So which means that would go over into March next year. But it's on 30th December that 30th September that the transaction was entered into. It identified the futures contract as a hedging instrument as part of a fair value hedging arrangement. The fair value hedge was correctly documented and designated upon initial recognition. All effectiveness criteria have been complied with, the 3 things we saw there. By the reporting date, which of course is before the exercise date, by the reporting date of 31st December, the fair value of the equity had fallen to 8 and the fair value of the futures had risen by 90. Now remember what I told you. What you may encounter in your exam questions is where the movements of both of them were the same as we saw with the inventory, this gold example on your handout just now. But in reality, the movement in the value of the underlying and the movement in the value of the derivative, the hedging instrument, would not necessarily be the same as in this example. What would always be the same, however, is that if a loss is made on one, a gain will be made on the other. Explain the accounting treatment of the fair value hedge arrangement based upon the available information. The hedged item is an investment in equity that is measured at fair value through OCI. Therefore, the increase in the fair value is 90 and the fall in the fair value of 100 since the inception are taken through OCI. Again, as I told you, if you were not told that, you could have rightfully just taken it through P&L. Debit derivative 90, credit OCI 90. That's this 90,000 here. Debit OCI 100, credit equity 100. The net result is a small loss in OCI of 10,000. Number 18. Clive has a firm commitment to buy an item of machinery for CU, whatever currency that is, for CU 2 million on 31st March X2. The directors are worried about the risk of exchange rate fluctuations. Obviously means that their currency is not CU, but they have to buy the machinery 2 million CU. On 1st October X1, when the exchange rate is 2 CUs for $1, so we assume Clive's currency is the dollar then. Clive enters into a futures contract to buy 2 million CU for $1 million on 31st March, which is effectively fixing the price there. Now remember though, as opposed to a calculation which you may carry out in your AFM, here we've got to account for changes in prices at the reporting date. At 31st December, X1 CU 2 million would cost 1.1 million. The fair value of the futures contract has risen to 95,000. All effectiveness criteria have been complied with. Now notice on 1st October, the exchange rate is 2 to 1. So Clive has a commitment to pay CU 2 million. But although the 2 million may be a fixed commitment, because Clive's currency is the dollar, not the CU, it means that exchange rates may change. So Clive may have to fork out more dollars to buy the same amount of CU or less dollars as the case would be. Which is why Clive entered into the futures contract to buy 2 million CU for $1 million. But at the reporting date, which we are not too concerned with in financial management, what we are concerned with in accounting, the CU would now cost 1.1 million, which is more, which means that potentially there's a loss then. But the fair value of the futures has risen to 95. Now, just one thing, you know, if you've been told if it has risen to 95 and so forth. Now, if you were doing a question like this in financial management, you would normally have to calculate those increases, those gains and losses. Not do double entries, but calculate them. And then having calculated them, the accounting people would record the double entries the way in which we've been doing it. That's why here you've just been given the value itself, because we are more concerned with the accounting. Explain the accounting treatment of the above in the financial statements for the year ended 31st December. If one, hedge accounting was not used. Now you know what happens if hedge accounting is not used. Remember, there's just a one-way transaction then, as we saw with the gold example initially. B, on 1st October, the futures contract was designated as a fair value hedge of the movements in the fair value of the firm committed to purchase the machine. So in the second one, we're using hedge accounting. A, the futures contract is a derivative and is measured at fair value with all movements accounted for through P&L. The fair value of the futures contract at 1st October was nil. We normally assume that at the start is nil. So if a question tells you, and again, this is why why I said a few minutes ago that in financial management you may have to calculate that. But when we are doing our calculations here, okay, and the examiner tells you it has risen by 95, what we normally assume at the start is that it literally had a nil value. So the 95 was literally a rise from 0 to 95 then. By the year end, it had risen to 95. Therefore, at 31st December, remember we have to use fair value accounting, Chive will recognize an asset at 95 and a gain at 95 recording P&L. You know, debit the asset, the futures investment, and credit P&L. One transaction alone though. Now that of course would mean volatility, because here you've got a huge increase in profits. Now let me just deviate here a bit in a meaningful way. Pretend that you're the accountant for this company, and this company does not use hedge accounting. So At the end of it all, okay, what you'll be showing in the financial statements, which of course must be disclosed and explained and all that, is you'll be showing some, and let's assume things worked in your favor, the company's favor, some huge gains. The problem is these gains are not directly connected to the company's normal trading operations, are they? You see? And you know, then what happens the following year or maybe quarter, you know, in the US, for example, some companies have to report quarterly results. But the following period, you show some huge losses because things had turned the other way. So this volatility then. Now the thing is, this volatility is not in any way related to the company's stock or bona fide operations. You know what they do then. In other words, you see, investors, stakeholders, and users of accounts may be of the opinion that this company things aren't going well at all if there were, you know, losses recorded on the derivative transactions. From the other hand, huge gains were recorded. Investors may be of the opinion, well, this company is doing really well, and if the gains were really a lot, and other competing companies in this line of business does not use, they don't record derivatives. Maybe they use hedge accounting, or maybe they simply do not use derivatives. It means that it may appear that your company is doing a lot better than them, or if there were huge losses, your company is doing a lot worse than the competitors in the same line of business. Now, one way of getting around that, which is why hedge accounting came about, is to use hedge accounting to remove that volatility in profits, which can be very misleading for investors using the accounts, you see. So in this first scenario, no hedge accounting was used, a one-way street. B, if the relationship had been designated as a fair value hedge, then the movement in the fair value of the hedging instrument, the futures, and the fair value of the hedge instrument, okay, are accounted for through P&L. The derivative has increased in fair value to 95,000. Purchasing CU 2 million at 31st December would cost Clive $100,000 more than it would have done at 1st October. Now remember again, only if hedge accounting is used would we do what we are doing here for the equipment. If hedge accounting was not used, all that will happen is this. In other words, if the futures, okay, was the futures transaction was carried out, but Chive had chosen not to use hedge accounting, this is what will be done. If on the other hand, the futures transaction was carried out and the company decided to use hedge accounting, remember it's not mandatory, they decided, then we'll have to do what we are doing here. The derivative has increased by 95. Purchasing CU2 million at 31st. Of course, they are not actually buying it at 31st, but we cannot have our cake and eat it. We have to, you know, do the adjustment necessary as well. Would cost over 100,000 more. Therefore, the fair value of the commitment has fallen by 100. At the year end, the derivative will be held at its fair value at 95, and again at 95, just as I said in A, we debit the value of the derivative credit P&L. The 100,000 fall in the fair value of the commitment would also be accounted for an expense in P&L. In summary, the double entries are as follows: debit derivative 95, credit P&L 95, debit P&L 100,000, credit firm commitment 100,000. The gain on the derivative and the loss on the firm are largely netted off, and there's a residual. Nonetheless, financial statement volatility is far less than if hedge accounting had not been used. And this is one, as I keep saying, one of the main reasons, perhaps the main reason why hedge accounting is used to remove that, you know. But again, remember, if hedge accounting is used, it must be properly disclosed. That's important because, I mean, different reasons why, but perhaps the most important one, the investors need to know exactly what's going on, of course. And remember, the investors may have investments in other companies as well, which do not even use any hedging technique. So at least they need to have all the information given to them. Now, so what we were dealing with so far was a fair value hedge. Remember, you told just a fair value cash flow. And I told you, as you've been seeing it in the illustration, the examiner would normally indicate. Now, accounting treatment of a hedge designated as a cash flow hedge. For cash flow hedges, the hedging instrument will be remeasured to fair value the reporting date, just as with the fair value hedge. But the gain or loss is recognized in other comprehensive income. However, if the gain or loss on the hedging instrument, notice, so now we are dealing with a cash flow hedge, a hedge designated as a cash flow hedge. And you were told for cash flow hedges, the hedging instrument will be measured to fair value just as with fair value hedges, but the gain or loss instead is not recognized through P&L but in OCI. However, if the gain or loss on the hedging instrument, like the futures, since the inception of the hedge, is greater than the loss or gain on the hedged item, then the excess will be recognized in P&L. So for example, let's say there was a gain on the hedge instrument. This hedge was designated as a cash flow hedge, and there was a gain on the hedge instrument of $100,000. But there was a loss on the hedge item itself of 90. Then the difference, the excess, would be recognized in P&L. And of course, the other way around. If it was 90, okay, loss on 100 gain, which means that there's a difference, okay. Sorry, if there was 100 loss on a 90 gain, 100 loss on the hedging instrument, and a 90 gain on the other one, the difference also has to be recognized to P&L. Question 19. I think this is the last question on the, no, there is one more. A company enters into a derivative contract in order to protect its future cash inflows relating to a recognized financial asset at inception when the fair value of the hedging instrument was nil. Remember, I told you we normally assume that at the start the relationship was documented as a cash flow hedge. By the reporting date, the loss in respect of the future cash flows amounted to 9,100 in fair value terms. It has been determined that the hedging relationship meets all effectiveness criteria. Required, explain the accounting treatment of the cash flow hedge if the fair value of the hedging instrument is first 85 then 10. Now what we see in here is the loss in respect of the cash flows itself 91, but two different values. Okay, now take a look at this for a minute. I just temporarily need to get a refill of my drink. So take a look at this, in the meantime. Just give me about 30 seconds. So the fair value of the hedge instrument, firstly, is 8,500, and secondly, 10,000, and the loss in respect of the future cash flows is 9,100. Now remember what we saw. If the hedge instrument itself, okay, the gain or loss is bigger than the gain or loss on the hedge item, the difference must go through P&L, but the majority of it will go through OCI. Here, the movement on the hedging instrument is less than the movement on the hedged item. Therefore, the instrument is remeasured to fair value, the gain is recognized in OCI. But note in the second one, okay, the hedging instrument movement is $10,000, which is larger than the movement in the item itself. In this case, the difference of 900 has to go to P&L. The movement on the hedging instrument is more than the movement on the hedge item. The excess will be recognized in P&L. Debit derivative, credit P&L, credit OCI. If the hedged item eventually results in the recognition of a financial asset or financial liability, the gains or losses that were recognized in equity, remember we are dealing with cash flow hedge, where gains and losses are normally recognized in OCI. Well, equity then, because OCI is part of equity. If the hedge item eventually results in the recognition of a financial asset or a financial liability, the gains or losses that were recognized in equity shall be reclassified to P&L as a reclassification adjustment in the same period during which the hedged forecast cash flows affect profit or loss. Example, in the period where the hedge forecast sale occurs. If the hedged item eventually results in the recognition of a non-financial asset or liability, the gain or loss held in equity must be adjusted against the carrying amount of the non-financial asset or liability. This is not a reclassification adjustment as of here, and therefore it does not affect other comprehensive income. Now, let me explain what we mean. Go to question 20 and 21. We look at both of them one time. On 31st October, Bling had inventories of gold which cost 6.4 million to buy and which could be sold for 7.7 million. The management of Bling are concerned about the risk of fluctuations in future cash inflows from the sale of gold. To mitigate this risk, Bling entered into a futures contract on 31st October 20x1 to sell the gold for 7.7 million. The contracts mature on 31st March X2. The hedging relationship was designated and documented at inception as a cash flow hedge. Meaning that the normal treatment would be gains and losses through OCI. All effectiveness criteria are complied with. On 31st December, the fair value of the gold was 8.6 million. The fair value of the futures contract had fallen by 0.9 million. See, one went up, one went down. There is no change in the fair value of the gold and futures contract between 31st December and 31st March, because 31st March is when they intend to actually transact. On 31st March 2, the inventory is sold for its fair value, and a futures contract is settled net with the bank. Discuss the accounting treatment of the hedge in the year ended 31st December, and then outline the accounting treatment of the inventory and sale of the futures contract at 31st March. Now, notice I reproduce here the note on your handout. That's this note here. Okay. If the hedge item eventually results in the recognition of a financial asset or a financial liability, the gains or losses that were recognized in equity shall be reclassified. Now, in this example, okay, the gold itself was sold for its fair value. When the gold is sold, it would create cash. Remember, it was sold. And of course, cash is a financial asset. So here, between 1st October, and that's important because you're told if the hedge item eventually results in the recognition of a financial asset or liability, the gold was disposed of, cash was received, you're told it was sold at its fair value. And if that is the case, the gains or losses that were recognized in equity shall be reclassified to P&L. Now, firstly, you were asked to discuss the accounting treatment of the year ended. So the selling of the gold and whatnot did not take place then. All that we're doing is we're carrying out fair value accounting, reporting date, discuss the accounting treatment of the hedge. Between 1st October X1 and 31st December X1, the fair value of the futures contract had fallen by 900,000. Over the same period, the hedged item had increased by 0.9. Remember, you were told here 7.7 and then 8.6. It just so happened it was the same thing. Under cash flow hedge, the movement in the fair value of the hedging instrument is accounted for through OCI. So the following entry is needed: debit OCI, credit derivative. Note, under cash flow hedge, the movement in the fair value of the hedging instrument is accounted for through OCI. Therefore, the following entry is needed: debit OCI, remember the hedging instrument, the value fell, credit derivative. The loss recorded in OCI will be held within equity. Now, B, outline the accounting treatment of the inventory sale and the futures contract settled on 31st March. The following entries are recorded. Remember, the gold was sold and cash was realized. Debit cash, credit revenue. Now, the reason is 8.6. Remember, you were told there's no change in the fair value of the gold on the futures between 31st December and 31st March. So, debit cash, credit revenue. Debit cost of sales, credit inventory. We do that to remove the inventory. Okay, remember it had cost 6.4. Now, that 6.4 is important. That's how we would recognize the gain or loss. To record the sale of the, well, that is the narration. To record the sale of the inventory at fair value. And then debit derivative, credit cash 0.9. Remember initially, debit comprehensive, credit derivative. So debit derivative, now credit cash 0.9. To record the settlement of the futures contract. Remember, it has to be de-recognized. And then, note this, debit P&L, credit OCI. Now remember initially, okay, this went through OCI as a loss. To record the settlement, well, that's this one. Debit P&L, credit OCI. To recycle the losses held in equity through P&L in the same period as the hedge item affects P&L, because it resulted in the creation of cash, the recognition of a financial asset. And that's why we needed to do this bit. Now, remember the second note said, if the hedge item eventually results in the recognition of a non-financial asset or liability, the gain or loss held in equity, as in this case, say the 900,000, must be adjusted against the carrying amount of the non-financial asset or liability. This is not a reclassification adjustment, therefore does not affect other comprehensive income. And that's what we'll see in this example. In January, Great Britain, whose functional currency is the dollar, decided that it was highly probable it would buy an item of plant in 1 year's time for 200,000 kroner. As a result of being risk averse, it wished to hedge the risk that the cost of buying kronas would rise. Remember, again, Great Britain's currency is probably more than likely the dollar. So they are concerned that krona would change in value. And so entered into a forward rate agreement to buy 200,000 krona in 1 year's time for the fixed sum of $100,000. The fair value of this contract at inception was zero and it was designated as a hedging instrument, meaning it met the criteria. At Great Britain's reporting date, 31st July, which was, of course, before the purchase of the equipment, the krona had depreciated and the value of krona 200,000 was 90. The fair value of the derivative had declined by 10. These values remain unchanged until the plant was actually bought. So from 31st July, the reporting date, until when the plant was actually bought, these values remain unchanged. The forward rate agreement has no fair value at its inception, so is initially nil. This is a cash flow hedge. The derivative has fallen in value by 10,000, but the cash flows have increased in value by 10,000 because it is now 10,000 cheaper to buy the asset. Because it has been designated a cash flow hedge, the movement in the value of the hedging instrument is recognized in OCI, debit OCI credit derivative 10. Remember, there was a loss, so to speak, on the derivative because there was a gain in the movement on the asset itself. Note, had this not been designated a hedging instrument, the loss would have been recognized immediately in P&L. That's right. See, if there was no hedge, let's say this company, okay, had not designated as a hedge, they had entered into the derivative transaction, but it had not been designated as a hedging instrument, so hedge accounting couldn't be used. The criteria were not satisfied. Remember, you were told one of the criteria, it has to be formally designated at the start as a hedging instrument. So if it was not designated like that, meaning hedge accounting would not have applied, meaning we do not need to consider whether it's a fair value or cash flow hedge, then it means that any movement loss would have been reported in P&L. The forward contract will be settled and closed when the asset is bought. Now, property, plant, and equipment is a non-financial item. Remember, you were told that they did in fact buy the equipment. Here, if the hedge item eventually results in the recognition of a non-financial asset or liability, we have to apply this thing here, which is what we are dealing with in this question. Property, plant, and equipment is a non-financial item. The loss on the hedging instrument held within equity is adjusted against the carrying amount of the plant. You know, I have here as opposed to being recycled to P&L as we saw in the previous example. The following entries will be posted. Debit liability derivative 10, okay. Debit plant 90. Remember, that's the, plant itself. Credit cash 100,000. Being the settlement of the derivative and the purchase of the plant. Remember, you were told here, okay, they entered into to buy for a fixed sum of 100,000. Then debit plant 10, credit cash flow hedge reserve 10, being the recycling of the losses held within equity against the carrying amount of the plant. That is what, okay, was meant by this. The gain or loss must be adjusted against the carrying amount of the non-financial asset or liability. Notice that the plant will be held at 100,000 and the cash spent in total was 100. This was the position that the derivative guaranteed. Now, as far as the calculations go, that's okay, what we've got. The remainder of this handout deals with the disclosure requirements and the discussion of hedge effectiveness. Now, what I'd like to do is I really need to make a start on the group accounting. So what I'd like you to do is from here, you can take a read through. We got some examples, but no actual calculations on the spreadsheet. And when hedge accounting should be discontinued, okay, which is not difficult to understand. And of course, the disclosure requirements, very, very important. Okay, and these are the notes, right? Now, also, where was it? Remember at the end of the handout, we've got all these appendices, the appendices which were identified as we went through the handout. Remember in appendix 3, okay, where was it? Yeah, this is the explanation of the net thing that I told you about. This is quite a useful example. You should certainly take a look at it, okay? A useful appendix. Right, now, so that's our handout on financial instruments, a very big one, included quite a lot. And that part on hedging, as I said, may have been a little bit confusing for students meeting this for the first time, but hopefully the explanation as you go through it, okay, you should be able to make sense of it. There is more to it if we were doing financial management, but this is what you need to know for your accountant. Now, as I said, now I sent you the handout before on introduction to groups, and what I would like to get straight into is looking at consolidated statement of financial position, the balance sheet. Then the way we'll be dealing with this, we look at all the relevant calculations and adjustments, and these adjustments are very, very important, because what you see, let me just explain. The previous P2 paper, corporate reporting, the first question would normally be a consolidated question where you actually have to prepare consolidated accounts. Now, this paper is not like that. It's strategic business reporting. See, what the examiner recognizes here is that as an accountant, okay, the preparation of the statement itself, the preparation of the financial statements consolidated, okay, would probably be done using accounting software and whatnot. But what the examiner, okay, will do here is this. Certain entries may have been posted, or certain omissions, okay, may be there. Things would not have been posted. And what the examiner would ask you to do is to correct these things. A good example is goodwill. Now, just about every exam would have something to do with goodwill in a consolidation question, where goodwill may have been incorrectly accounted for. And you need to apply your knowledge of the procedures in order to correct it. So that is your main focus, not simply the preparation of a full set of consolidated accounts. Of course, as we go through the questions, the scenarios, if you actually got a chance to go through it just yet, you'll see that the question did call upon you to prepare a consolidated balance sheet, and so forth. because the only way that we can look and see the adjustments is, of course, to see it in the form of the balance sheet. But it's extremely unlikely for your exam that you'll be asked to prepare consolidated accounts, a full set. Now, let me just get rid of this handout here. And I guess what I can also do is um, now with your, what was it? Okay, now two handouts were sent to you here. I actually did earlier today. I also sent you the worksheet that will be used. Okay, but previously, a couple of days ago, I sent you this one, and I sent you, okay, this one. Right now, this first one, um, it's well, it's not strictly a revision, but what it actually deals with, it deals with the information that you need to know about, okay, when preparing consolidated financial statements, both P&L as well as the balance sheet. So it's you should read through it. I mean, hopefully you did get a chance. I did tell you if you can. I did ask you to read through it before today's class. Um, IFRS 10 establishes principles for presenting and preparing consolidated financial statements. And this is very, very important because if you'd forgotten, okay, your consolidations from your financial report in F7, these things would come in quite handy. Now, there are just one or two things I need to point out, though, okay, from this handout. Firstly, IFRS 10 requires an entity, the parent, that controls one or more other entities, subsidiaries, to present consolidated financial statements. Now, whilst it is possible you may encounter a situation where a parent has two subsidiaries, the more than likely scenario is where a parent has one subsidiary, which makes it a parent, and also an associate investment. And you may have to deal with those three, which of course we look at. So requires an entity that controls one or more other entities, subsidiaries, to present consolidated. Defines the principle of control and establishes control as the basis for consolidation. Sets out how to apply the principle of control to identify whether an investor controls an investee and therefore must consolidate. Now, the rules for control, those rules are very important, and there's a separate handout I have which I'll be sending to you, which shows you what is meant by control, because it's a bit of a big deal, okay, when dealing with this sort of thing. Typically, though, as far as the preparation of accounts go, control would mean there's a subsidiary parent relationship. Where it does not, control would normally be there's an associate relationship. Sets out the accounting requirements for the preparation of consolidated financial statements, and defines an investment entity and sets out an exception to consolidating particularly subsidiaries of an investment. Yes, if certain conditions exist, then the parent may be exempted from preparing consolidated accounts, even though there's a parent-subsidiary relationship, and that is also noted on this handout. Consolidated financial statements are financial statement that presents assets, liabilities, equity, income, and so forth of a parent and its subsidiaries are those of a single economic entity. See, when we are doing consolidated financial statement, we use what is called the single entity concept. And when consolidated accounts are prepared, we first show the accounts as though it is a single entity, but then also show the extent to which it is not. In other words, then we combine everything and then we give back, so to speak, to the non-controlling interest. In other words, the fact that we only own 80% and not 100%. But the single entity concept is important. You see, why that's so important is this. When consolidated accounts are prepared and the single entity concept is applied, that means although the parent owns 80%, it consolidates as though it owns everything. You do not, for example, prepare a consolidated balance sheet with showing only 80% of the current assets, 80% of the non-current assets, and so forth. You consolidate everything. And then with the non-controlling interest entry, which is portrayed on the balance sheet, we show the extent to which we do not actually own everything. But in consolidation, we do not apply the 80%, we apply 100% or whatever, And then, of course, we got the objectives, very, very important that you do go through this. Okay. Scope, control. The concept of group accounts. What is a group? If one company owns more than 50%, this will usually give the first company control of the second company. The first company, the parent, has enough voting power to appoint all the directors, and the second, and so forth. Parent is in effect able to manage S as if S was merely a department of parent rather than a separate entity because it has control. In strict legal terms, though, P and S remain distinct, but in economic substance, they can be regarded as a single unit. See, remember, legally, there is no single entity, so to speak, with P and S. Legally, they are two separate entities. But for accounting purposes, here you have economic substance then, as opposed to legal form, they are regarded as a single unit, a group. And this is why here you've been told, although from the legal point of view, every company is a separate entity, from legal point of view, from the economic point of view, in other words, economic substance, several companies may not be separate. In other words, we'll use the single entity concept. And here you have it discussed a little more. Okay, now this single entity concept, again, is very, very important. Okay, the purpose of consolidated accounts is to present financial information about a parent undertaking and its subsidiary undertakings as a single economic unit, show the economic resources controlled by the group, show the obligations of the group, and show the results the group achieves with its resources. Business combinations consolidate the results and the net assets of group members so as to display the group's affairs as though of a single economic entity. As already mentioned, this conflicts with the strict legal position that each company is a distinct entity. Applying the single entity concept is a good example of the accounting principle of showing economic substance over legal form. Okay. And then the consolidated financial statements and the single entity concept. Okay. All very important. Okay. Now these all apply to you as well. Okay, so then you've got definitions that go along with it. Okay, now the examiner may ask you, as I said, I mean, this theory is very, very important. Requirements for consolidation. So IFRS 10 outlines the circumstances in which a group is required to prepare consolidated financial statements. And generally, it should be prepared when the parent company has control, establishes more than 50%. And control is identified in the following way. Now, let me just move on a bit and show you something. One of the things that you need to know about in SBR, which you were not taught in your financial reporting paper, is changes in group structure. So, for example, a parent may own 80%, and then it sells off part, and it now owns 60%, but it still controls. On the other hand, the parent may own 80% and sells off 40%, so it no longer has control. Another scenario is where an entity may own 30% of the shares, so it does not have control, and then it makes a purchase of 25%, which takes it to 55%. or an entity owns 30% and it makes an additional purchase at 10%, which still does not give it control of. All those things you need to know about in SPR, which you were not taught in your financial reporting. Okay, changes in group structures is something which is more specific to SPR. Right. Remember, I said that there are certain times when the parent may not, actually have to prepare. Very rare, but exemption. A parent need not present consolidated financial statements if and only if the parent itself is a wholly owned subsidiary or partially owned subsidiary and its owners have been informed about and do not object the parent not preparing. The parent's debt or equity instruments are not traded. The parent did not file its financial statements with the Securities Commission or other regulatory organization for the purpose of issuing any class A instrument. The ultimate parent company produces consolidated statements that comply with IFRS is available for public use. You need to know these things. You need to know these points because quite simply in a question, or maybe not so simply, the examiner may ask you whether directly or indirectly. Okay. And notice as well, when exemption from the preparation is permitted, IFRS 10 requires the following disclosures to be made. You need to know these as well. Very, very important. Okay. And some reasons for wanting to exclude a subsidiary and so forth. Okay. So please read through this handout in its entirety. Is very, very important. Now, okay. Now, what I'll be doing, okay, in the in order to save some time because we've got some work to finish off still, is now I did actually to go through it, and what I will be doing, I'm not sure whether I'll do it for this particular handout, okay, but I will do it for some of the others. I think let's see how it goes. Is that I'll be sending you the recordings related to the handout, okay, which you may have to go through the recordings on your own then, and because it's as I said, I need to speed up a bit. We have some work to finish still, and now I may do it for this one, but and if I do that, it is very important that you do go through the recordings and the handout in its entirety. Now, the reason why I may do it for this one is because quite a lot of what you may see on this handout is what you may have covered in your F7. But when we get to changes in group structures and so forth, stuff which you would not have done in F7, well, clearly, I mean, I will go through it with you. The handout that we do after this one is looking at the consolidated P&L, which again, things haven't changed much in that handout from what you would have been taught in F7. So let's see how it goes. As I said, new stuff, certainly I will need to have the class with you in order to go through it with you. But if I send you a recording, let's say for this, the questions contained in this handout, I will expect you to diligently and clinically go through it. Because when we do take it up a notch and look at changes in group structures, it's all based on the knowledge and the information contained in this handout as well as the worksheet. The worksheet is very, very important, for you to understand. Be that as it may, I will still take a quick run through and say, okay, if you'd gone through this, you'll probably see this, and maybe on a few of the calculations, still go through it with you. Just to make sure at least you're okay, with the handout and the material content. But as far as the financial instruments go, I know it was a bit of a testing time. Hopefully the explanations that I gave to you made it easier. But by nature, financial instrument, as I keep saying, is not the easiest thing to follow. Okay, and the reason for that, it's really a combination of financial management and financial reporting. And I think in my reckoning, I think that is what makes it a bit challenging. Okay. All right then. So that's it for tonight. Okay. Um, so look out for my emails and correspondence. I'll send you this recording tonight self, as I tried to do with the last one. And that's it. You stay in touch, and you take care, and I'll see you then.